What is the risk that you've seen last week in markets say to you about the lack of belief? This is a question I asked the CFO at ING. There's an utter lack of belief that the mechanisms to resolve bank problems really have the capacity to do what they say they'll do on the tin.
I think there's two elements to answer that question by. One is I think you have to look at the resolution mechanism itself, and I think it's comprehensive, and the capital buffers within banks around the world are much more rigid and robust. The second element is what is the specific issue due to Deutsche Bank. Deutsche Bank does have the capital and liquidity necessary to get by. It really is a problem of this shock of what are their outstanding fines. Is the Department of Justice fine at $14 billion going to crucify the bank? But then the bank is not broken. It can be recapitalized. And the question will be, under what terms might the German government want to recapitalize the bank? You don't have to bail it out per se. It's a recapitalization, which is a very different issue from a bankruptcy, I think. And I think the confidence issue is therefore not quite rightly interpreted by the marketplace. There's another element to this, that because of regulation, desks have what they call CVA, credit value adjustment. And under credit value adjustment, banks are supposed to buy protection in the marketplace against the credit risks that they have. And therefore, in rather thin and illiquid markets, swaps desks, etc., are buying Deutsche Bank CDS at a broader level than they would do, because that is the process that they have, and that creates a slightly distorting effect, in our opinion, to the CDS market. This didn't exist in 2008. Now it does. So in many ways, the actual signal that the CDS is giving you is saying that the market is better placed against residual underlying risk, in our opinion.
Anna's going to hop into the conversation here.
Good morning, Anna.
Yeah, good morning, Chico. I mean, we heard from Caroline that some of the big names on the Xetra DAX were jumping to the defence of what they see as their national champion in the banking sector. Some of them even saying they're going out and buying bank stocks. Is this a sector that you feel comfortable buying at the moment?
That's a really interesting question. I mean, strategically, banks are in the eye of a global storm, whether it's due to economy, whether it's due to regulation, whether it's due to the interest rate story. So from our perspectives at StockCube, we think that the banking sector overall is one where broadly you might want to avoid over a longer time horizon. Shorter term, there are always going to be tactical opportunities within it, and potentially now this is a tactical opportunity within European banks because we believe the negative press against them is so high. But structurally, the headwinds which banks face have been articulated earlier this morning in terms of what is the right business model, digital versus do people walk into the branch. The second element is this low interest rate story, which we keep hearing, or negative rate story, obviously, for Europe. And that itself is part of something which I don't think people really do appreciate. We've heard Larry Summers talk about secular stagnation in the world, but nobody really understands properly what secular stagnation means, because the globe has not been affected by something like this for over 50 or 60 years.
You're right, beginning to understand what secular stagnation is. But the consequences of the Deutsche Bank story, the consequences of secular stagnation, it is this. We've got a pie chart in terms of the consequences. 2.2 trillion of sovereign debt here in Europe is now beyond the reach of the European Central Bank. These risk-off events really do move markets. What I've got for our viewers here is the Bloomberg Barclays Global Aggregate Index. The amount of negative yielding debt in the world has just ramped up by 6% in 1 month. We're at 12 trillion and rising. Does that continue, and does that invoke, if that's a reach for yield, but then you have these moments of huge risk off, where does that leave you in the last quarter of the year?
Okay, so let me take the first part of your question. The number of securities around the world with yields below zero is a consequence of central bank policy and a consequence of the reach for excess savings. In our opinion, it doesn't really matter whether it's the central banks who buy the bonds to take the yields below a certain level or whether it's the central bank itself. Effectively, if the marketplace is doing QE for the central bank actually has to buy fewer bonds. And in many ways, that is a positive consequence for the ECB because its balance sheet doesn't have to increase. The alternative side, which is what you were approaching, is the market purchasing more bonds at yields below zero a sign of concern about the system overall? In part it is, but in part it's not. It comes back to this theory of secular stagnation. We should just touch on it a moment. There is a fundamental economic concept which has not been given the airing that I think it should be, which is the concept of the neutral interest rate. What is happening globally now is the neutral interest rate is declining. The neutral interest rate is the rate at which economists believe an economy will neither expand nor contract. Because of structural effects around the world, it is decreasing. In Europe now, the neutral interest rate is minus 0.5%. So with the ECB having an interest rate of minus 40 basis points, the rate is neutral. It's not actually positively stimulating.